Okay, good morning, everyone. Welcome to the Options with Option. My name is Josip Kasek. Please take a moment to read the disclaimer here. Um, we are not financial advisor. All the examples that are going to be presented here are for educational purposes only. Let me also show you a place where you can get in touch with us here at the Tradactive. This is a page where you can book the coaching if you want. Also, all the notes that I take are usually posted here. On the last session, we have taken the two bull put spreads. One was on a diamonds that hit the target, and the other one was on a Tesla. We can revisit that once when the session starts. And I will now share my top platform with you. And we're going to start with the big picture because a lot has changed since the last session. So what I'm doing right now is quickly going over the monthlies just to show you how big difference several sessions last week could make. So we are going to be looking at one by one of these four major ETFs. And when we look at these four major ETFs on the monthly, we're going to notice that quite a bit of things have changed in terms of where the price is versus um, what has happened last time when we were looking. Because last time when we were looking, for instance, on the diamond, um, it was testing the low. And since then, the diamond has rallied off the low, but it's interesting that it's still contained within a range of the previous bar. So as of now, diamond is not testing yet the high of the February, but as of now, it's pushing higher. So after two down months, we finally have a green month on a diamond. If I now look at, for instance, SPY, I will notice the situation is quite similar because institutions are investing pretty much equal amount of money in these two majors, Dow Jones 30 and S&P 500. However, on a QQQ, you will notice a slight different situation because the QQQ is technology. And what was interesting that the technology did come to the February 24th low. And then when it bounced pretty much with the vengeance. And as of now, it's going up. But what is interesting, I cannot draw this line from the low of the February 24th to the low of the March as a higher low because we had here equal low. And that's really an important thing to take into consideration that not all these markets are same. One of them is different, and one that is different more than anybody else is the small caps or the Russell 2000 that has the most number of the stocks in it, and it's just about ready to take out the high of the February. So if we need to choose on which one we should go long, it's definitely would be IWM. So having said that, I will now pull up the options with options, and I will look at what I like to call the standard deviation versus the current number of bars that we are lifting. So one more time, just to kind of go over with you in terms of the big picture. I'm gonna finish this big picture in a moment, but I have taken the time to prepare myself for this session so we don't spend that much time on the big picture. We spend most of our time executing the trades. So what I have done here, I have put here SD, that stands for the standard deviation versus current. On a VIX, statistically speaking, we can be 8. Currently we are 4, which means we can still go down, and then I'll go through each out of these in a moment and explain it. So let me now just start with the VXX, which is a volatility index. Going from the top to the bottom, I'm actually looking where are we in relationship to this 9 um, period exponential moving average. And for the last 4 sessions right here, we've been actually below it. But according to the standard deviation, we can be additional 8 statistically speaking. So hence, when I extract those numbers to be side by side, because Albert Einstein said once, everything is relative, everything is comparable to something else, I know that standard deviation on the VXX means we can go down additional 4 days, and we are only 4 out of the 8 days. Now, if the VIX goes down, that's mean that market should go up. And just a big picture of what the market is doing today. This is a website that I like to use quite frequently. If you guys can just tolerate all these ads that are quite annoying, that often distract you. Market is up across the board about the 1%. Of course, S&P is up the most, as you can see right here. S&P is up 1, but the Nasdaq is up the most. And Dow has this gap that has left behind, and it has not filled it. And what is interesting, whoever decides to go long will need to take into account that what goes up can also go down, because this gap is much, much smaller on a Nasdaq, and it's much smaller on S&P, but Dow has left the gap. So moving on in my analysis to the Dow and looking where the Dow is in relationship to its moving average, you will notice that Dow has been on a rip, breaking this downtrend that has been in existence for a while. And for 5 consecutive sessions, it's been closing above the 5-day moving average. And this is where we are currently on the 55 minutes bar, opening above the resistance and just hanging with this huge gap right below us. So one more time, be aware of it, that going long right now on the Dow is not the wise thing. Another reason why I don't think going long on the Dow would make sense is for a reason that 5 currently bars closing above the 5-day moving average versus the statistical count based on the standard deviation 5. So no trade on a diamond, and I just want to kind of point out to you that you know that the diamond and SPY are pretty much the same. Therefore, it's going to be same on a SPY, and I'll show you the IWM in a moment, but you would see 4 standard deviation versus currently 4. It's the same thing. As long as these two numbers are the same, you should be kind of very, very cautious. Now notice one is unlike another, and that is a QQQ. And let me now prove this with the fact, not with the opinions, but with the fact. Let me pull up the Q. Q finally today has a tick dot. And if you can type in, oh, good morning, Mark. Good morning, Jeff. Good morning, JB. I'm glad to see you. Good morning, Joe. So we are looking at a 9-day exponential moving average, which is this one right here, Jeff. And we are currently noticing that on a QQQ, according to the standard deviation count based on the statistics, for 7 days, statistically speaking, we could stay above it, and we are as of now only 4 days. So if there's going to be a one product that we can maybe consider going long, that would be perhaps a technology sector. And what is interesting to notice in the technology sector, there was a resistance right here that we blew right through it. Right through it. So if that's kind of making sense to you guys, please give me a check mark, because I really want to jump in more trading this morning than just talking about the big picture. So I know it takes a couple of minutes to do that, but while you're doing this, I'm going to bring the Thinkorswim platform and go over one of the trades that we placed on a Tesla. And when you have a position open, one of the easiest way to figure out what is going on the position is simply to look at what is the price that we have traded. So as you can see over here, we have traded Tesla at these price levels, and currently they're right here at these levels. So what we did, we actually sold 790 and bought 770 just as a hedge, just as a protection, as if you're wrong. And I remember as we were going up, I said, you know what, I'm not going to even put a target on it, because my goal is to see this expire worthless. And as you can see right here, this is just about ready to expire worthless. So I will now point out on the chart, and I'm going to change this to daily when I switch this to Tesla. How is that looking on a daily chart? So we are all the way down here at the 770 when we had that session, because the market at the time was heading lower. Since then, the market in general has broken the downtrend and has ripped to the upside, and it has gone straight up. So there's a couple of things that we can do with this trade. We can completely exit that trade and not anymore worry about it. And one of the ways to do it is simply you highlight this, you single right click, create the closing order, and we're going to be exiting it for 8 cents. So when I click this, most likely I will get automatically filled. And the moment I got filled, I got the price improvement of the 7 cents, which means initially I was putting online how much money? It was about the 2K. And now that I have clicked this, buying power effect of the $2,000 had been freed. My buying power has jumped, and now I'm able to utilize that money to trade other trades with the puts. And the reason why I want to trade with the puts, because over here, we have a volatility, and a gray line represents the put and a blue line represents the calls. And obviously the gray line means that the puts are being traded more. So if I go back to the IWM, and I'm looking right now in a situation on the daily, I see that we're coming in the resistance, but we also have down here very interesting situation that we are away from this green set of unfilled orders. And again, the puts are being traded more than the calls. So I would like to now, due to the fact that, as I pointed out to you, actually, I was saying that we're gonna do on the Qs, not on the IWM, due to the fact that the standard deviation are 7 statistically speaking, and when something is on the rip, you better get out of the way, or like you should probably consider maybe placing the trade on that. So we can still be up for 3 more days. Now, my little bit concern is here that we are coming into this UFO. So we're going to be looking at the different UFOs on the QQQ before we just blindly place the trade on. Or another thing that we can do, rather than just trading the QQQs, we can pick either the XLK, which is a technology sector, which is also entering into the lot of unfilled orders, or another one is XLC, which would be communication sector. And between the two, I actually prefer the XLC because it does have a little bit more room to the upside. So for those of you who are not really familiar with these sectors, I suggest that maybe on a FinViz you can just type in the two words XLK, X and L, and then stop, and you will notice um, all the other letters that are in existence that represents the S&P 500 tracking sectors, such as B, basic material, C, communication, E, energy, are being listed. So you don't need to be inventing the wheel. You just ask the FinViz to actually spell out for you which are the existing sectors. So the reason why I brought you here, because I want to show you the XLC, and you would see over here, XLC is uh, is a communication sector. Communication sector. It shows you the average volume. What is it? And one more interesting thing, because it's a sector, you don't need to worry about the when is the earnings. You don't need to worry about the when is the earnings. And in this area, and I'm going to just zoom this in a little bit more, you can actually even see where the simple moving average is. And as I say, if you can tolerate these ads, like then you can put up with it. So we're down below the 50-day moving average, down below the 200-day moving average. We're just slightly above the 20-day moving average. So there's a definitely possibility for us to take a trade on XLC. So why are we trading the trade on XLC? We're trading the trade on XLC, first of all, because we're above the 9-day exponential moving average. We do have I would prefer to have a thick line right here. I know on the QQQ, when I look at earlier, we finally have got the confirm thick line. So that's mean the confirm uptrend. But on XLC, as you can see, we do not have a confirmed, where did I type in? Uptrend. Well, it all depends where the market closes. If the market closes above, then we are going to have a confirm. And then the dilemma really becomes for us if we're going to actually hit this with the bull put spread. If we're going to hit with the bull put spread, so let's say we decide that we want to do the bull put. How aggressive do we want that bull put to be? So there's three type of bull put spreads that we can do. We can do the bull put spread where selling to open out of the money. We can do the bull put spread where we are selling to open out the money, and we can do the bull put spread that we are selling to open in the money. This in the money is aggressive because it is going to need a directional rip to the upside. Okay? Obviously, this is the one that is a classic, or the one that we like to call conservative, because in that case, we just want the price action either to stay above or even to go down, but we will get paid something. Now, the classic and aggressive something in between that is called a moderate. Moderate also starts with M, and which means market, and I will in a moment type in exactly where the XLC is. So let's type in XLC. And this is a simulated account. It's a live trading. We have about $6,000. And I want to point out to you that basically, if you can just round this up 2 cents higher to 69, just to understand this concept. So if at the market we're at the 69, okay, then we can be selling to open one contract of at the money 69 put. If we're going to do the aggressive one, we would need to be putting something that is higher. So let's revisit over here and pick maybe 72. So in that case, if I pick 72, if I pick the 72, what I can do with the 72 is anticipate the move of at least $3 higher, because if the price then becomes at 73 at the close, if we are now closing at 73 at the expiry, then a 72 would be out of the money. But what the beautiful thing about the aggressive one is that we're going to get the greater credit, right? On a conservative, we're going to get the least amount of credit, but then we won't be picking the 69, we won't be picking 62. We're going to be then selling to open out of the money, and I'm going to be sticking just with the one. And again, I need to have a chart tell me, but one of the things that I've been teaching for you consistently, that you can actually have a market maker disclose to you, if you would switch this to the volume and open interest, where is the highest activity? So highest activity in terms of the open interest is right now at this level right here. And when you're looking at this level, it's actually 67.50. 67.50 is the one that has been traded the most in terms of the activity. Now that's the one for a 3 days out. That's the one for a 3 days out. Now there's the one thing that I'm really concerned about. If I want a three digits, there's not that much volume and there's not that much activity on this particular cycle. So I'm late for picking the 67.50 for the out of the money on this cycle, which doesn't mean I should not do it at another cycle. So I'm going to go to the April here, and just to see what is the liquidity on a April. And I'm seeing the much better liquidity on April, such as at 64. As you can see, the 64 has a way better activity, which doesn't mean I need to pick the 64. I can also pick the 65 because it has a three digits, right? So if I were about to place the trade on a 65 that is out of the money, which is in the realm of possibilities, then I would be out of the money how many points from the current price? So that would be out of the money by 4 points, okay? If I pick this 69 out of the money, 65 put. Now, of course, I would need to have a protection, but I don't want to talk about the protection right now, because this buy to open unit would need to be just a one unit that is below 65. Over here, same thing. If I'm doing the 69, I would need to pick, I don't know, whatever I pick, either 68 or 67 or something below. But the beautiful thing about the aggressive one, in a short little period of time, I would know whether I'm right or wrong by picking, let's say, 70. So if I stick now that I want to do the 2-point wide trade to be done, then over here I will be picking 67. So that would be then out of the money. This one would be we here out of the money, 67 put, right? On this one, if I'm picking below 65, which is also out of the money put, right, I will be then picking 63 put. So I'm going to now look at the pricing of these in top. So what I'm doing right now, I'm opening the chain. I'm selecting which expiration, April regular session, and that would be April 14. I'm going to be getting rid of all of these other ones, and I will be now comparing them side by side. And again, I'm going to start first with the out of the money, then I'm going to progress to the at the money, and then I'm going to look at the at in the money, and then we're going to be choosing which one to do. So when I move this right here, I want to just focus on one thing at a time, right? So we said the 63 and we said the 65. So 63 and the 65 are the ones that we want to be focusing on. So the top, TradeActive Option Planner has actually highlighted for me these sections right here. So what I can do here, just to kind of make sure that I extract the most important information, I'm going to just cut this area right here that has a bid and ask of each of them and kind of put it in a Word document, and then we can entertain this without losing any of the attendees in terms of what we are doing here. So we said we're going to do the 65. This is a 65. We would be buying at the ask, and the ask is what? 60 cents. Is that good or is that bad? If the ask is a 60 cents of the debit, and I want to, against that debit, sell this out of the money put that is above it. Actually, 63 is 40 cents. My bad. Let me just correct this. 40 cents for the 63 debit. That's this one. And then selling this 65, I'm getting the credit at a bid of 55. That's mean I'm only getting the 15 cents. So keep in mind, over here I would be getting the 15 cents. And hint, 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 if I can just do this for you, this is risking $2 to make the 15 cents. My maximum risk, how do you get the $2? 65 minus 3 is $2. And if I do this trade when I'm getting debited 40 cents and I'm getting credited 55 cents, then really my whole risk on this trade is $1.85. I'm going to leave this thing alone because I don't want to make any judgment. As I pointed out to you, Albert Einstein said, everything is relative in relation to something else. Mark, I agree with you. The climate is not confirmed on that. However, I'm going to run these 3 examples, and if you conclude that's not good enough, I'm going to use that same template, and maybe I'm going to then jump into the XLK that is confirmed. Okay, so let's just now jump back to the TradeActive here and alter these strike prices. And as a reminder, we said that this second batch that we are doing, and I'm going to make this into not bolded so it's kind of easier to understand, 67 and 69 is what I want. So what I'm doing here with the platform, I'm just moving this to 67 and to 69 and getting rid of the 65 and 63. So when I have the 67 and the 69, I'm going to do the same approach. I'm going to just cut this little area here and put it in a Word document because less is more. Less information to focus on is easier for us to kind of understand what we are really looking at here. And I want to do this as fast as I could because, as Mark pointed out, we may not be even placing the trade on XLK, but I do want to teach this concept. Why do we do the bull-put spread? Well, bull-put spreads earn the money when it's uptrend, and depending on the strike selection, it can be profitable if it's sideways, which means our classic conservative one, if the price went sideways, we would still be able to earn money, right? So if we did this, we would earn our 15 cents. I just don't like the risk that is being placed on it, right? On this one, we are slightly bullish on it, while on the last one, we're definitely aggressively bullish on it. So let's talk about this, that we are slightly bullish on it and figure out what is going on here. So if I got the 69 sold for $1.85 at the bid, how much of that money do I need to give back? It's actually a 95 cents. Well, that's the one that looks to me way more attractive than the one that we are getting only 15 cents and risking the 85. So let's now do this. So we're going to edit the spread. We're selecting bullish. Specifically, we're selecting the bull put When this thing loads up, we need to change it to the April 14th, which is a regular option. They picked the 69 correct for us, but we are picking the lower price at 67 because we said we want to be consistent and we want to have everything done properly. And when you're looking right here, we are getting about the 73 cents. Well, now I just stick to the 70 cents. So if I take those numbers as being accurate at 70 cents, so we still have a $2 that we are risking, and again is $7. That's mean our total. So $2 is a maintenance or a margin, right? Then my whole risk is $2.30. Okay. So having said that, I want now just to cut the corners and to point out to you what is going to be if I now go ahead and do the aggressive one. The aggressive one is going to be, and I'm going to edit the spread quickly by changing it to we picked if I'm not mistaken, we picked the one that is at 72 and 70. So I'm going to change this selling to the 72 in buying of the 70. And I'm going to click OK, and I'm getting $1.45. Now notice the beautiful thing here. If I'm getting the $1.45, I'm only risking 55 cents. I'm only risking 55 cents minus $1.45 of the credit that we get with the risk of 55 cents. So if the market continues going up, that would be the choice. Now, one thing that I want to emphasize here, and to be consistent, I'm going to take also a picture of this one in a moment here, is if there's no open interest or volume on these things, I'm automatically dumping this using the template for the XLK. If I can't find an XLK, I'm going to revisit the QQQ because I remember on the QQQ we have a standard deviation and a current that might work in my favor. So one more time to be consistent, I'm selecting here the strike prices of the 70. I'm going to uncheck the 69, 67, and also 72. And now that I have this, I'm going to just scroll it down over here, and I'm going to just kind of cut them and put them side by side. Because when I eliminate something, I need to have evidence, and that evidence should not be opinion, but it should be a fact. And I approach this very scientifically, and I want nothing else but the fact. There's no room for opinion, right? So this is now 4 of them. I was saying to you that this is aggressively bullish, but taking into account when the shorts are still under the shock that the market has moved up, there's really no limit where this thing can go. So if I now look at my activity on open interest, do I have over 100 contracts? On open interest, do I have 100 contracts? For educational purposes, in a paper trading account, I'm firing this trade in because not too many traders would even consider doing this trade. So there's the same information that top was giving you, 106, 103. Do not worry about the volume being 4 and over here nothing, because you're the one selling it. You're not the one buying. So how do we do it? We single click here on 72. We go where it says the sell, and as soon as it gets filled, soon it gets filled in a template, we would need to be clicking plus sign to reduce everything down to the single contract. Because I click on 72, the nearest strike price was the 71.50, which I would need to alter to 70 in order to see what is the best that I can get. So of course the market is dancing around. I originally had the 135. By the time I'm ready to place that in, it's a 135. I will get greedy. I will ask for 145 just to kind of show to you that then the math would be correct. For my loss of the 55 cents, I can make it 3 times as much. I'm going to place this trade in. I'm not going to even try to tweak it. I'm going to leave this thing dancing, and I will point out to you over here my buying power effect is only $55. So I'm going to let this thing sink in. So one more time, theory behind the bull put spread. Pull put spreads earn money in an uptrend. Depending on a strike selection, it can be profitable if it's sideways or even in a slightly downtrending market. It is a credit spread that has a mathematically defined a maximum loss and maximum gain if it's held until the expiration. There are two strike prices involved. The higher one is the one that is being sold. In each of these examples, we are talking about the higher one that is being sold. So this is my obligation. This right here is my obligation. This one right here, it's my obligation. I'm going to leave it in the bold, and one that is not obligation, I'm going to make it into not bolded one. Oops, I clicked the wrong thing. So be aware of it, that although you have a two legs, it's only the commanding unit of the 172 that you want. So while we're waiting for this to fill or not to fill, we're going to revisit XLK, and we're going to see, is the XLK in any chance confirmed? Because as Mark has pointed out in the chat, this is not confirmed. So we are now clicking XLK, and we're looking for a thick dot, and it is confirmed. Now, the reason that I didn't like the XLK, because the XLK is coming into what kind of the unfilled orders? Red unfilled orders, which means that we might be having a problem. So let's now jump to the right away XLK, assuming that I'm going to do the same aggressive trade for the April. And I'm looking at right here, this area that says open interest is also showing. Let's see if I can add 3 columns. Okay, so I'm going to add the 3 columns right here. So I'm going to have here first one that is going to be a volume. This is going to be the intrinsic here, and over here I'm going to select also open interest. So I have 3 columns here that I want you to look at, right? So the intrinsic value of the 158, because we are currently at 157 and some change, is about 81 cents in the money. If I go further up to 160, then that's about the $2.77 in the money. So when I look at the chart, 160, that would be somewhere inside the second UFO. Okay, that's how aggressive that trade is. But when something is on a rip, when something invades something, like there's no limit where this thing is going to stop. This is now currently on a rip. This is on a rip. This can defeat these red UFOs by simply going higher and higher and higher, for a simple reason that buyers are present. But one thing that we want to make sure is that there are trades. There's no 3 digits. There's no 3 digits. So I'm ditching XLK, and I'm going to look at the QQQ. I'm looking at the QQQ, and by the way, these are the 3 digits on the open interest. Selecting April, there's definitely a lot of activity over here. A lot of activity. 360 has a lot of activity. So let's revisit the QQQ. I'm revisiting the QQQ. 360 is not that far. 360 is, we can even pick 361 if there's any activity on 361. If there's any activity, because I don't want to be only one betting that it's going to go to 361 when everybody else is aiming 360. I'm going to pick 360. So now if I'm going to pick 360 and I want to do the $2 spread, then this is the way how we would do it. We would single right click on a bid, because we are a seller. Bull put is a vertical credit spread. The word credit spread means we sold something. And when I single right click, I know that broker is gonna automatically fill in for me the lower strike price that is nearest. I want a $2 spread so I can compare the oranges with oranges. So now I have a $2 spread. I purposely left this on a 10 because that's a default setting of the platform, and it forces me to slow down in my execution. So I'm gonna aim to get the 90 cents of the credit while I'm risking about $1.10. Okay, so this would be almost one-to-one type of trade, one-to-one trade. If I would go a little bit higher, it can be better. So still between the two, I kind of prefer the XLK, although it's still unconfirmed. So I'm going to fire this one in. And now I'm going to go under the monitor tab, and you're going to observe that I have two of them here that are waiting to be filled. Because my buying power effect on a QQQ is 110. This is what it's showing, 110. I've been waiting now more than 2 minutes for filling the XLC, and they didn't give it to me. I'm going to try to walk it down to the 140. So when I walk it down to 140, I'm observing two things. First thing is it doesn't go in a penny increments, which is very different than a QQQ. So if I now change this, my whole math behind it is changing. So now I'm no longer risking $55, I'm risking the 60. Set it in. Obviously they're not jumping. They're not too eager to do it. I'm going to look at what is going on with my QQQ. Maybe I'm asking too much. 90. I'm going to walk it down. Over here it says, oh, we would naturally fill you at what? 87. So how about if I give you 89 and see if you're going to fill me at 89? Again, this has affected my buying power outlay by adding one more dollar to my maximum loss. Sending it in. Not changing. Not changing. I got filled for 92. This is wonderful. Now that I know where I got filled, I can proceed with what I really want to do. I'm going to now go over here where it says a fill orders, and I'm going to even widen this thing up so I can capture the exact time when we did this. By the way, I'm not suggesting you do this, but occasionally when something like this happens and I want to have a memory where the physical underlying was, I would go ahead and I would just purchase the one single share of the QQQ at the same time when I got filled, just as a reminder where I'm in. So I'm buying the one single share just as a reminder when I'm in. Again, you would do that based on the size of your account. Because some of you would say, like, well, I don't like what you just did, because you just risked 300 and whatever the price was, $356.71 for a trade that originally you had only $111. You don't need to do this. It's just me. I like to have the something tracking like that. So what I'm doing right now, I also got filled on my XLK. I'm going to do the XLC. I'm going to do the same thing for the XLC. So XLC is much cheaper. It's only $68. I'm doing the same thing, buying not 100 shares, just a single share, because then I have a footprint where exactly price was at the time when I got filled in. Now again, this is now not paying any commission, so I don't need to worry about overcoming commission, and I have a exact indication where this thing was. It's just a trick as a trader that you can do, because when you're now later on filtering these things and you say, okay, I traded the XLC. I know I got filled for 140, but I'm wondering where the price was at 8:42 Pacific Standard Time. Well, you didn't need to be wondering, because you threw in additional $68.88, and you can now use that trade with your stop and the target and treat your bull put spread just accordingly. If you like that, feel free to type it in. Okay, Mark, you got filled even at a better price than I do. That's wonderful. That's wonderful. So let's finish this thing up, because I want to make sure that when I'm done with this, you have a clear indication what we have done this morning, right? So I have here the prices on which I got filled on the QQQ. 1020 and 928. So I'm going back to top. I'm pulling up again the option chain. And in the option chain, just as a reminder, we have traded the April 14 expiration using the 360 and 358. So April expiration, April 14 to be specific, expiration, 360 and 358. 358. Now notice both of them are in the money. And that's what I was pointing out to you, that this needs to be then really considered as aggressive trade that needs to move. So we're going to have that highlighted on calls. But as I mentioned to you, calls are irrelevant to us because we did not trade the calls. We did not trade the calls. We're trading the put. And 1020 is for the higher one, 928 is for lower one. 1020, higher one. So one more time, bullish, bull put spread, edit the spread, change it to the April 14, selling 360 at the filled price of the 1020, buying 358 at the filled price of the 928, and then observing that we got 92 cents, taking a snapshot of it that shows that it's a bull put spread and it's at 92. Keeping this for my record that is going to get posted in a moment. And just like I was showing to you before, that I have here three things that I usually take a snapshot of: my fill ticket, the name of the strategy, the breakdown of the strategy, how much we are risking, and also the risk graph. I'm going to do the same thing for both of these trades. Same thing for both of these trades. So obviously I have a first two things. I need the two more things here. Okay. So what I'm doing next is simply single right clicking here where it says risk graph. When the risk graph gets populated, in this section right here is my mathematical breakdown of my risk and reward. So I can just snapshot this. Actually, so it takes just a few seconds for me to do this. Dump it inside and then moving on to the Word document where I'm placing these things in and doing the same thing for a QQQ. Same thing for a QQQ. There's one more piece that I'm missing. It's this. So just be patient here with me. Okay. On QQQ, actually what I want to do now, I want to place the target on this. I want to place the target. And what do you think the target is going to be? Target is going to be when we reach the 360. So that's mean the QQQ would need to lift from the current price, which is a 356.78 to 360. And when it reaches that level, I just want to exit my entire spread. So I'm going to type in here QQQ. Just like I have here QQQ as a single leg, I'm going to create the opposite order. Opposite order is going to be good till cancel when we hit the 360. So when we hit the 360, I want to sell that one share. I want to get out of that share. Make sure that you change it good till cancel. So that means I'm going to get out at the 360, and when this one single share that is long gets closed, my spread is going to get closed too. So same procedure. Create a closing order, which means create an opposite order. Good till cancel. Hit this little bubble. Bring this in so everybody will see what we are doing here. Submit at when a condition is QQQ trigger at or not below, but above 360. Okay, save, confirm, take a moment to proofread this. When the QQQ is at or above 360, send it in. So now I go over here and I'm seeing that these two are taken care of. These two are taken care of. So if you have any questions, this is the time to ask in the chat box, because I want to make sure that you understand. Here's all the relevant information what we did on the Q. We have a ticket when we took a trade. We have an explanation of it here from top. We have a risk graph, and we have a breakdown how much. Now, of course, could it be that we did not make the $108 when it goes to that level? Yeah, but as long as we close this by giving back something out of the 92 cents then. So let's say we give them back 22 cents, right? In that case, we made the 70 cents or $70 on a risk of the 108. So then you see like, oh, this was actually a good trade. I'm going to now repeat the same thing for this, so this is now QQQ. So now I'm doing the same thing here for XLK. And what are the steps? Well, the steps are very simple. I'm going to first go to the XLK, and I'm going to take a snapshot of the, I'm sorry, I say XLK, but it's XLC because I know XLC wasn't confirmed. I can even take a picture over here so it shows exactly where the stock was at the time when I entered. This is one of the things that I get in my emails. Could you help me to evaluate my option trade? And I have all the option premium information, but I don't have a price of the physical underlying. I need to have a price of the physical underlying so I can talk with authority about the trade, whether or not it's good. Otherwise, I would need to be scrolling on the chart, finding exactly 42 minutes at 8 o'clock on that certain day, and it's always a drag. 340 by 2, 340 by 2, and this was a 70 and 72 put. 70, 72 put. Okay, so what do we do next? We go back over here. We're gonna now get rid of this one because we're looking at the XLC. You see, the execution really takes a less amount of time, but doing all these other things, it eats up the time. So April 14, we sold 72 and we bought 70, and we did it for $2 and for $3.40. So higher one received the $3.40, lower one received the $2. So this is a lower one. Oops, needs to be exactly 70, and this needs to be 72. This be 72. Okay, so $3.40, $2. Hi Ahmed, I'm glad you were able to join us. We went ahead and we placed the two trades. I'm just going over the details that we are doing here. So we did the bull put spread on the XLC, although it wasn't completely confirmed trend. However, by the end of the day, we might get that tick dot and it would be then confirmed. And then we're gonna go back to the top and simply single right click to get the risk graph. And on a risk graph, I'm gonna point out to you here, this section is for me more essential than actually the risk graph, because the risk graph is showing what is going to be at the expiration, but I'm going to be exiting this trade even before the expiration. I'm going to in fact be exiting this trade as soon as we hit the 72. But I want to have this because we have a lot of people who are very mathematical, especially because the company is from Singapore. There's a lot of people who like all the possible details on the math, and that's exactly what I want to post in that Excel sheet that you guys gonna have access to if you go to tradewithufos.com/ type in my name. It's going to be posted right there, and you're going to have two of these trades at the end of the day. Okay, so we have gotten all the relevant information here. We are almost out of time with our session, but I don't want to rush it because I now need to explain the most important things. We got in a trade. We also need to get out of the trade. And how do we get out of the trade? So watch the steps. First, I'm selecting that single share that I bought just as a tracker so I know where the thing is. I create opposite order. I change my day order to time in force, good to cancel, and I alter this to the price 72. 72. When I confirm it, I should not get filled because I'm saying you're not allowed, market maker, to fill me unless the price is 72 or better. The reason why I did the one share because they got rid of the commissions for stock trading. If this was really a commission of $5, there's no way that this trade would make sense. No way it would make sense. So I'm now sending this in, and now that you know how I'm managing this one single stock trade, you would probably be aware of it that the same management is for the bull put. So again, make sure that you don't add to it, right? Make sure that you select opposite trade. So first thing that I did with the stock trade, time in force. Okay, then I click on this little setting wheel, bringing the whole thing so you can see it, what I'm doing. I'm not changing any of this. We're buying because initially bull put spread is a credit spread. We sold it. So now I'm buying. I'm going down over here and I'm typing in the ticker. When an XLC is not at or below, but at or greater than or equal to 72. 72. Okay, so now I'm saving this and I'm firing it in. Okay, so before I fire it in, this line probably from all the lines that are here is the most important line. And why do I say that? Because that's my conditional order. I have a conditional order. That's mean that all these other things are not as relevant because all that they're doing right now, they're quoting me where the price is. Well, I know the price is right there, but where's the price going to be at 72? We can anticipate that later, not right now. So I'm sending this thing in, and now it's in. So you will now see that I have a green line and I have a red line. The red line is for a stock because I bought the stock, therefore I need to sell the stock. Okay? With the option spread called bull put, I did flip. I first sold for a higher credit. And when the price goes higher, that means value of the put goes lower. It's just like a car insurance. You had the car insurance and you sold your car, and now you're calling your insurer asking for a prorated money back of your premium. So you had the coverage on it, and that's the coverage that you were covered. And legally, insurer can keep that. But returning back some money to you means that you no longer need the car. In this case, if the price rallied to 72, I'm giving back some of the credit that I have received. But I no longer have obligation, my $200 get freed. So is this $200 getting freed? So I have done here what Albert Einstein calls a relative trade. I have two trades that are at somewhat similar environment. One is on a technology and one is exactly on the communication sector. Okay, the one is better than another in terms of the analysis. And what I mean by that, well, when you're looking at the QQQ has a really confirmed trend. XLC probably by the end of the day is going to have a confirmed trend. Okay, however, both of them have a put that is what, higher than a call, because this blue line represents the call and gray line represents the put. The reason why I don't think the XLC is such a good trade is that count of the statistic information based on the past is 4, and we are currently already at the what? 4. So that right there should have not been traded with the real money. On a QQQ is a different situation, because on a QQQ, based on the statistical facts, 7, but over here we're only 4. That's mean for 3 more sessions, it is possible that the QQQ gonna go into this area and come to our target of 360. So it's interesting to have this and to see which trade is gonna work out better, right? So again, I disclaim it at the beginning. This is for educational purposes only. I quoted Albert Einstein, who said, everything is relative, everything exists when compared to something else. So we have presented the 2 trades, XLC that has a $200 risk, and also the QQQ that has a $200 risk. And one has received 92 cents. One has received $1.44. I have been taking this uh, information over here, so you will know that here we are risking $108 to possibly make 92. On my XLC trade, we are getting the $140 while we're risking the 60. So one is more aggressive than another. So we started the session by saying the bull put spread has 3 kinds. It has a classic kind that is very conservative, that uses out of the money. But when it uses out of the money, it doesn't even make a 10%. If this was a 20% right here, if I was getting the 20 cents on a $2 investment, that would be then 10%. These, we don't know what we are gonna be end up making, because they are what? They're aggressive, which meaning it's a directional, and it needs a rip to the upside. But knowing with everything what is going on right there, I would not be surprised if this thing just keeps going higher and higher and higher. Look, it's already up here. It has broken this downtrend, and where exactly it's going to stop, we really don't know. So we started the session by simply looking at the big picture, which looked at the standard deviation versus the current one. We could have placed the trade on volatility. It's just that this particular ticker VXX has a story behind it that I'm going to share with you maybe on Saturday when I do the sharpening session. So this one we skipped for a simple reason that it already shows that according to the standard deviation, 5 days up. After 5 days up, we turn down. Same thing with the SPY, same thing with the IWM. But one was unlike another, and that was this one, QQQ. Now, within the QQQ, we had the communication sector, and we also had the technology sector. We chose the communication sector as our template on which we were working. And then when we looked at XLK, we didn't like it because there wasn't enough liquidity for us to get in. And then we switched it to QQQ, which had the better liquidity. So I would like to ask you to take a moment to type the feedback. And if you're all good, I'm going to bid you good day. And make sure that you stay hedged. You really don't know when this market is going to move either one way or another. We have a gap below us. We can get down to that gap, fill the gap, and then go right back up. And I really look forward to seeing all of you, Ahmed, Mark, Jeff, Joe, JB, in my session on Saturday when I'm discussing assignment. And also there's going to be an article that's going to be coming up soon. Let me show you where the articles are getting posted on our website. So articles are getting posted down here when you go to the books and articles. And then you need to scroll it because there's a books, and then there's below all the recommended books, there's the articles. And when you scroll it all the way down here, this is where the articles start, right? So I think I already pointed out to you that I wrote one article on managing Tesla option butterfly. You can read that. This is where another article is going to get published, and it has to do with the assignment. So having said that, I'm gonna bid you a good day and make sure that you always stay protected and hedge. Have a good day. Bye.